Hi everyone, thank you for logging on with us today. We're just going to wait a couple more minutes for a few more folks to sign on. Thanks. Hi everyone, welcome to the TBR Webinar series. Today, Senior Strategy Consultant and Principal Analyst Geoff Woollacott, Analyst Cresta, and Senior Analyst and Engagement Manager Brian Belanger will be discussing Wallet versus Will, Transformation of Government Technology. Before we get started, we have a few housekeeping notes. At the bottom of your screens, you'll see a series of buttons. From left to right, you can access the slides, audio controls, Q&A, speaker bios, our survey, and social sharing. After the event, you will receive an email with the replay link as well as a link to other TBR webinars. If you have any questions for us, please submit them via the Q&A widget in On24. You may also reach out to us after the event at webinars@tbri.com. Thank you again for joining us. Here's Joey to begin the webinar.
Thanks for the introduction, Sarah. As Sarah noted, I'm Joey. Many of you are familiar with me. I engage directly with a lot of the familiar, friendly faces that I'm seeing logging in today. So nice to see you. Thanks for joining us. As some of you know, and some of you may not, I'm the lead analyst here at TBR for our public sector research practice, focusing on the IT and professional services firms, centralized on public sector services, primarily within the U.S. federal government. Joined today by Geoff, our Senior Strategy Consultant and Principal Analyst, who's been working with me closely on this broader concept that we're calling Wallet versus Will, which we'll get into here today, as well as Brian Belanger, an Engagement Manager and Senior Analyst here within our Tailored Services practice at TBR. Brian and his team have been helping me out a lot as I'm engaging with our clients in the public sector around some more customized service offerings in areas like pricing and organizational strategy, operational benchmarking, and things of that nature that have been helping our vendors that we work with understand the disruption in the market and sort of what the best practices are from a go-to-market and an internal organizational structure perspective. With that, we can jump right into the next slide, which is just a quick overview of what we're going to touch on today. Many of you will be familiar with some of the content today. I'm going to start out with a high-level overview of the 1Q18 Public Sector IT Services Benchmark that TBR is actually publishing today. So that'll be hot off the presses at some point later this afternoon. So within that, we will look at the overall benchmark performance of the vendors that we are tracking in the sector. Included in that will be the ever-popular vendor bubble chart, where we look at positioning in terms of profitability and growth across the competitive set. And I'm going to spend a few minutes as well talking about Perspecta, which we did not officially add to the benchmark in 1Q18, but we have started our research on the company. Obviously, a new entrant, so to speak, into the sector will be a factor in some of these transformative things that are going on in the market. So we'll touch on a lot of that. Then we'll pivot over to the discussion on Wallet versus Will and sort of the misalignment in the rhythms of government and the rhythms of business and what that means for the services providers and how they go to market, how they price their offerings, and sort of culturally what the impediments are to really engaging in truly transformative work for government. And that dovetails nicely into a lot of Brian's work around business model disruption within the public sector. So from there, we will go into that. We'll save some time at the end for Q&A. You can use the chat function to send us feedback. If you're having trouble hearing us at all, or if you have questions, you can ask them through that. We will, for the sake of keeping things moving, probably hold on Q&A until the end, but we will be checking the chat function throughout this presentation. So with that, we can move into slide 4. This is straight from the benchmark. To orient you to what we're looking at on this slide, we have 3 growth lines. The red line is year-to-year weighted average aggregate revenue growth for the 16 companies within the benchmark. Our blue line is the trailing 12-month growth rate for the benchmark vendors, and then the organic year-to-year growth rate as well as the green line. So really what we're seeing here is it's a very exciting time to be in the government services market. It's interesting, first of all, to follow the administrative policies and try to make sense of what's going on disruption-wise, simply from a political perspective. That in and of itself is a bit unique and very different from the previous administration, and it is having legitimate business impacts on the vendors that service the market. Secondly, In addition to that, the growth rates are accelerating within the sector. So it's becoming a much more dynamic and interesting time for providers within the sector. Certainly over the past 5 years, we've seen nothing really like this. I actually looked back this morning and saw that the trough in the growth rates within this current benchmark vendor set was a 7.8% year-to-year revenue contraction in 1Q14. So significant improvement compared to a lot of the challenges earlier in the decade. And a couple of other notes here. Look at the tightening in the growth rates between total and organic growth. Really the inorganic maneuvers of the past couple of years, the large-scale deals, like the formation of CSRA, for example, CACI's acquisition of L3's national security business, that was driving a bit of an artificial growth within the market as we were seeing the total growth rates rise due to the inorganic contributions. And you can still see that lingering in the early part of 2017 with organic growth still declining in the low single digits. Vendors are truly achieving organic growth at this point within the market. We do see that accelerating into 2Q and across 2018. I would note that our 2Q revenue estimates here do not include DXC because what we've essentially done is pulled out their U.S. federal practice as that's pivoting over to Perspecta in the spin-out. So to mitigate the impact of that, we've excluded them from the 2Q18 growth rates. But overall, certainly a healthy environment. We're seeing backlog growth across much of the competitive set. A bit of a speed bump in 1Q18 to an extent due to the extended continuing resolution of the federal budget, but all signs are looking really strong, especially with the 2-year budget deal. We're seeing spending caps busting and some of the strongest investment, peacetime investment in defense that we've seen in quite a long time. So all really encouraging signs, but to get there, that means aligning to the demands of what the market is currently looking for. And you see demand signs in areas such as the President's management agenda, where there's a heavy focus on increased utilization of shared services and managed services and automation and offloading non-core tasks onto the service providers so that the agencies can focus on their core missions. So that's creating a lot of opportunity, and we're going to get into what that means in terms of how to align to that and best position for the growth opportunities that are emerging in the market. We can move on to the next slide. Here is our bubble chart. So this is the vendor positioning across the 16 vendors that appeared in our 1Q18 public sector benchmark. To orient you to the slide, so we have 3 types of vendors that we're calling out here. First of all, you have the red bubbles, which are the core TBR public sector practice area. Those are the companies that I cover on a day-to-day basis that I know at the deepest levels. Really heavily focused on the federal services pure play vendors. You have your Leidos and Agility and Booz Allen Hamilton. Firms that may have a small presence in the commercial sector and at times seek to expand into near adjacencies like regulated verticals and certainly some international government expansion initiatives, but by and large generate the vast majority of their revenues from the U.S. federal government. Secondly, we have the green vendors. So these vendors, I have colleagues here at TBR who cover them as deeply as I cover the core TBR public sector practice, and in collaboration with them, they help formulate my understanding of these firms. So you're looking at CGI, Accenture, IBM, and DXC, which again will be transitioning to Perspecta starting in 2Q18. And then finally, we have our benchmark-only companies. These are companies that I have an interest in maintaining a knowledge and understanding of what they're doing within the market. We do not currently produce syndicated research on a company-specific basis on KBR Wiley or ICF or Unisys, but we do view them as interesting and influential within the market. First of all, I think the thing that jumps off the page with this bubble chart is KBR Wiley being literally off the charts in terms of their growth and operating margins, heavily focused on acquisitions and acquiring their way and developing a government services market position as their legacy hydrocarbons business is kind of eroded. In 1Q18, 65% of KBR's overall revenue came from KBR Wiley, which is across U.S. federal and Australia and the UK. They have a pretty solid presence in those countries as well. So essentially overnight, they've emerged as a $2.5 billion federal IT services player through their acquisitions, first of Wiley and then Honeywell Technology Solutions, most recently through Stinger Gafarian, where they're expanding their presence with NASA as the federal government has emphasized space as an important domain. So they're entering those areas and certainly a very interesting firm to cover. By and large, though, what I want to point out here is that as we're looking at the market, what we're seeing is that the firms that are performing best are those that are a bit farther along the digital maturity curve, have aligned to the trends occurring within the marketplace. The best example of that being CGI, which has certainly emerged over the past couple of years as a strong performer within our research, benefiting from their efforts to be more like Accenture, more consulting-led. They're embedding IP into their digital solutions. We're seeing with CGI in some cases shorter duration of contracts with a smaller total contract value associated with those. But what we expect there is for them to convert those into longer-term IP-based transformative or managed services engagements, which is supporting their high margins and their strong growth rates. For example, this came up recently that CGI is participating in a program in Canada to drive economic growth through the implementation of smart technologies that are leveraging 5G. So they're working with several other companies in the country in partnership with the federal government as well as the provinces of Ontario and Quebec. Ericsson, Ciena, Thales, and IBM are also on that program. But that's just a great example, and kind of what we're going to talk about a bit more when we get to Wallet versus Will is the need for consensus building toward transformative engagements and the need for proof of concepts and pilots that then can be scaled into broader engagements and leveraged across markets to expand wallet share. So that can happen as well in the U.S. government, for example, if you want to move from Army to Navy to Air Force. Expanding your capability, broadening it across customer sets, that's going to lead to revenue growth and diversification opportunities for the companies that are best positioned today and doing the right things to capture positions on those smaller scale proof of concept, developing use cases, positioning yourself for future growth. Another thing worth noting here is you see Accenture actually a bit below the average operating margin line for the quarter. I think that's an interesting observation here to make because Accenture has basically been the CGI of our benchmark for quite a long time. But we know, for example, that Accenture has been experiencing some margin pressures within their health and public service group. Executives have cited that and called out some large-scale programs. So it may be the case that Accenture, as they're getting more aggressive around expanding and sustaining their revenue growth that's been very strong for a number of years, they may be moving into some lower margin areas or taking on more risk through cloud-based deals that maybe don't bring in the same margins on the front end, but lead to longer-term margin upside. And then finally, the last company that I really wanted to touch on here is Booz Allen Hamilton, because we've been talking a lot about the digital maturity of organizations, and as the federal government moves to procure digital solutions, being a digital firm is an aspiration, but it's a challenging one for companies to compete against your more agile and nimble, born on the cloud or cloud-native disruptive companies. Booz Allen is one of the ones that I see as really doing the things to position themselves to be more digitally mature. They've had their Vision 2020 strategy for a number of years now. What I'm seeing them adopting is a more rotational leadership structure where they are bringing in some of the folks from their strategic innovation group, the SIG, that really drives innovation across the company. And they're putting them into new positions to really infuse that culture across the company. So the former cyber lead within the Strategic Innovation Group, Angela Messer, she recently was named the firm's first Chief Transformation Officer. Gary Leibovich, he's focused now on modernizing their operational management systems to support their growth rates, also a SIG alumni. This is similar to moves we've been seeing them make in the past, like Karen Dayhut, the SIG founding director and chief innovation officer, moving into vertical leadership. They're really infusing that culture across their company, and that's helping Booz Allen sustain its strong performance. Belied by their position on the chart here, they actually had a slowdown in growth during the quarter, but I do expect that to reaccelerate across 2018. And a lot of these trends that we're talking about here in terms of digital maturity and aligning to the market, that's driving moves, I think most notably in General Dynamics' acquisition of CSRA. That's one that we're obviously going to be watching very closely. I have some concerns about how that one is playing out thus far. I think underscored most significantly by the abrupt departure of George Batsakis as the Chief Growth Officer. Legacy CSRA, influential and really driving their strategy as a standalone company. And it really seemed to me like CSRA kind of caught lightning in a bottle with what they had. And I just wonder if there's a misalignment, culture trumping strategy and the highly decentralized business and the focus of GD on margins on a program level versus more of the risk-taking strategy of CSRA. I think they're running into a bit of trouble there. That's something we'll continue to monitor through our research over the course of the next year as we see how the integration plays out. We can go on to the next slide. Quickly, I just wanted to touch on Prospecta. As I noted, we'll be adding them officially to our coverage. So you look at this chart, and not a great position. This is trailing 12-month public sector revenue, profitability, and year-to-year revenue growth, as opposed to just the 1Q18. What I'm seeing from Prospecta right now is it looks like an emphasis on cleaning up the books a bit within DXC, USPS. I think they've accelerated some of their amortization schedules, and that's driving some margin compression for Prospecta in some of the legacy modeling that we've put together. But I'm seeing pieces that I really like about Prospecta, and I see them as having an opportunity to be the next CSRA within the market. And really what it is taking advantage of this point in time to say, you know what, we're going to engage in some self-disruption. We're going to align to where we think the market's headed. We're going to take advantage of maybe a chance to adopt a new culture and kind of get reinvigorated as opposed to being part of a legacy organization that may have been beaten down by competing investment priorities or cost cutting or those types of things. It's a new start. It's a fresh start. And CSRA proved how quickly you can transform when you get that type of fresh start. So I'm excited to watch that. Prospecta has over 1,000 Agile certified staff, so they're aligned to the trends of Agile development. Over 50% of USPS's revenue coming from fixed price contracts. That's the highest fixed price content across the vendors that we track. The Vencore piece that they're bringing in, very much more mission focused, very much more cost reimbursable, which aligns with the more systems engineering and integration focus of that organization. But some interesting pieces coming over from Vencore as well. What I'm really excited about is Vencore Labs, which is doing applied R&D for DARPA, the intelligence community, and DoD research labs in areas like cybersecurity. Now, this is not early stage exploratory or basic research. It is applied R&D in near-term applicable solutions. I see it as an opportunity to give Prospecta a competitive advantage in developing technology using customer-funded R&D that can then be applied across the business. So some things there that I'm excited to look for in them. I do expect to see the margin profile improve as they start official operations. It looked like to me adjusted EBITDA margins could be in the 9% to 10% range. Again, factoring in things like acquisition integration and restructuring costs. Those are going to weigh down the company for a while, but I think there's strong opportunity for Prospecta moving forward. And with that, we can jump into the next slide. And I think, here I'll pass it off to Geoff. But Geoff, the things that I'm saying there about Prospecta, basically, they're in position here to align themselves to what we're seeing in the market. So if you can talk about what is wallet versus will, and what should a firm like Prospecta be looking to do?
All right, sure. Thanks, Joey. This is a somewhat messy slide. It's very much a theoretical slide. So I will talk to it moving left to right and from top to bottom. First thing I'll do is work on the diamond. The top half of that, where it starts with defense at the tippity top, that's what we're calling the old government procurement model for technology. It was largely driven by wallet. In other words, when the economics of the technology were not at a state where enterprise would adopt it, the government may be in the lead to get this because of quote-unquote protection of the commons. So typically what we saw is technology was adopted for defense, protection of the commons, then for some of the civilian agencies as well, as the price points came down a little bit. Then within there was the regulatory mechanisms, i.e. Department of Treasury taking a look at banks or regulating healthcare. The next down from there would be the regulated industries. The old adage I had is that it went to, as Jack Benny would say, your money or your life. It either went to the financial services industry or it went into the healthcare industry. And then as the prices got a little bit lower, you got into the broader commercial adoption, typically from financial services down into retail because the payments were heavily linked and so on and so forth. That was essentially the way in which technology has gone into the public sector and then flowed out to the right into commercialized applications that were then used in the private sector. What we've seen, it was at IBM Think, a lot of the IBM executives were using the term that with all the disruptions that are going on and moving from analog dollars based in the hardware to digital pennies and the new subscription services, that the axis had flipped. So if you look at consumerization there in the middle of that diamond, that to me is the hinge that is flipping the axis and flipping the way that technology is being used, because the consumers, i.e. we the people, are demanding a better consumer or technological experience. So now if you go down to the bottom of that diamond where we're talking about the will, having been a selectman, I am speaking a little bit from this, but all it takes is a progressive elected official in a small community to be able to grab the public sector apparatus by the throat and get them to do some things because they can get the will, they can build a consensus at a small scale for RFID readings of meters, smart cities, automating the traffic lights and the flows, all these things that we're hearing about. You then have it moving up into the state level where, again, you can have, say, major transformation in the registry of motor vehicles and the customer experience that goes there. And it can happen in one state. Now, that state, if it's done in a good or useful fashion, there is a repeatable framework to go sell to 49 other states or counties or however that may work. Now, the challenge as you come up into that is to get the federal government sector to be able to break down the agency silos and cooperate and collaborate and share information. I mean, there was one of those awful shooting incidents where somebody misfiled a report in one military agency, it didn't get to the FBI, and so on and so forth. Homeland Defense was built after 9/11 with the auspices of coming up with a single standardized database. The other area where there needs to be that kind of cooperation or partnership is really with the private sector, where, as we're hearing in the private sector, that data management, data governance as we move into the digital economy is critical. It's coming right at the board level. It's not just for the regulatory compliance to quote-unquote stay out of jail. It's also for the brand and for the sentiment analysis, so you're not Zuckerberg testifying before Congress because of a privacy breach. And here enterprises are able to, or are working, I should say, with the strategy-led advisory firms to build that data governance map. Well, with the interactions between government, citizens, and businesses, there needs to be that kind of cooperation and standardization of data that feeds into and out of the federal government that could be leveraged for useful purposes for private enterprise in dealing with its employees as well as in dealing with its consumers. These things require will. They don't require money. They require consensus and cooperation and collaboration. And as we know, this is one of the more polarized political times that we've been sitting in. And typically, as one person said, government does one of two things in a crisis. It either does nothing or it overreacts. But it doesn't do anything until we, the people, tell them we're in a crisis. It would be nice if they could get ahead of this a little bit and mitigate some of the disruptions that are going to come from the economic shifts, both in labor skills, unemployment rates coming out of the legacy industries that will be automated while we have to reskill that labor to put them into new jobs. There's a whole host of things that are coming up where if we had the will, we'd be able to, through the public sector, mitigate some of the disruptions that are coming when, in this individual's opinion, what's going to happen is the public sector is going to exacerbate those disruptions. Now, that's the diamond. What does it mean? The left-hand side of this is the selling components. The right-hand side is where technology goes. Buy points and the way you sell into the federal government has been, it hasn't changed that much for decades. It's very few buyers because of the prices and expenses that were associated with it. It was oftentimes bespoke because there weren't commercial repeatable frameworks that could be deployed. So you were hand carving these things. It was private sector terminology was large ITO deals. And we have seen in the private sector, large ITO deals are going away. It's impacting the professional services economic models of all these firms, because rather than that 10-year deal, you're getting a 3-year deal, and it's primarily a managed service with a little bit of what we're calling at TBR an innovation speed bump, i.e., to retire the technical debt or refactor the technical debt to take advantage of the managed service. You've got a sort of a one-time hit. But after that one-time hit, you have the managed service. That is what is coming. That isn't what's there today. It's bespoke, it's siloed, and it's protection of the commons. Now, the technology was flowing out of government into commercial uses. GPS and satellites is one of the classic examples. High-performance computing, all those instances of Cray boxes at Livermore Labs and Oak Ridge and so on. As Moore's Law economics did its thing, it was brought down into general-purpose compute. So it was the RFP goes out, bid comes in, the innovation flowed out of the government into the private sector. Today, if you go down to the bottom, let's go bottom right, Moore's Law impacts. You've got cloud software as a service. You've got commercial IoT. You've got robotic process automation. And you have, of course, mobility, which is where we, the people, are demanding easier access and entry points into government agencies to seek the information we need when we need it, wherever we want to get it, rather than having to go from 8 to 4, 5 days a week to sit in line. That is a way that we, the people, are demanding these things. And what you see coming out of it is the transformation proof of concepts coming from the private sector. It is being showed, and then through a catalyst event, you can develop the personalized shared services. It's experience-driven, but the bottom line is that it requires consensus. Now, in terms of examples, it's coming. Here's where the challenge, the rhythm of business is accelerating. The rhythm of the public sector really hasn't changed since the founders drafted the Constitution. Deliberative bodies. We're talking fast failure. We're talking agile development in the private sector, and we still talk about deliberation in the public sector. I mean, take the example of GDPR. It was enacted in 2016, I believe. It replaced an act of the EU from like 1995, so it's like 20 years that this thing had been around, and then they gave them 2 years in order to be able to get ready for it. 2 years is a lifetime in technological innovation cycles today. So the whole rate and pace and speed of change within the public sector has got to get moving, and politicians are going to have to get better at public-private partnerships and admitting mistakes.
Well, to your point, Geoff, I know one of the things that you
the Unisys deal?
Well, first I was going to talk about Northrop Grumman, actually, because so Northrop has really pulled out of a lot of the commoditized, lower-end traditional ITO, saying, that doesn't really fit our margin profile. Right. But where they will still play is in complex systems integration and business systems, ERP systems, the most complex business systems modernization work that's out there, they will get involved in that. And I know the program that stood out to you was the Global Combat Support System, Army, the SAP-based automated logistics ERP system that it took Northrop 10 years to achieve full fielding of Increment 1. Granted, through a new system that's replacing over 40 legacy systems, but the point is, I mean, to you, I think that stood out as like, that's just way too long and unacceptable for any commercial enterprise.
Absolutely.
To take 10 years in an ERP modernization.
Absolutely. I mean, one of the things I do, I work on custom projects at TBR, is I do executive level interviews, CXO level interviews with large enterprises about emerging technology adoption and what their pain points are and so on. And to the point about the axis flipping, the things that get me to stand up and pay attention are things that run counter to my preconceived notions based on 36 years in the industry. And one of the ones that's been hitting, particularly when you talk about AI and those types of projects, is these interviewees that I'm dealing with, who are very high level, have regularly stated that the project duration it's taken less time than they expected, and that things are moving faster than they anticipated. That is not what used to be said, particularly like with an SAP ERP instance. I'm going back to R2, R3 days in the 90s when CIOs lost their jobs, falling down on that. But the idea that it would take a decade for any enterprise to transform one of their backbone software platforms is just not acceptable in the private sector anymore. And it goes to the JEDI contract that it's really when Joey and I started getting together on public sector, where it was to be an exclusive 10-year deal for military cloud, when that's what private enterprises were doing when they were looking at hybrid cloud back in around the 08, 09 timeframe. But today it's all about multi-cloud and the easy, seamless deployment from one cloud to the other. So at the risk of sounding overly critical, it sounds like what the DoD was putting out in that contract would have been a great proposal for ITO 2.0 deals that were still like 10-year deals back right around 08, 09. But today that just isn't heard of, and it doesn't make any sense. The only way I could argue that it does is if it's that sort of cybersecurity threat, you want a single sort of dome for in the event of a balkanized internet that you could just turn on in order to protect the country. But it begs the question of what would it mean for the enterprise that was on the Azure stack? But yeah, the last one before I'll be quiet and move to Brian is the Unisys deal.
Yeah, it's a logical transition. Yeah, that's great, and it does speak to what you're talking about as we shift more from bespoke to configurable solutions with repeatable frameworks and commercial off-the-shelf technology. Unisys, this is a great example of this.
Right.
A $250 million TSA recompete for essentially what the TSA was looking for was a platform for data integration collected from passenger and baggage screening equipment at airports, and then providing a cyber risk assessment component on that to understand the cyber risk of those equipment, the security equipment within airports. Unisys was going up against incumbent General Dynamics Mission Systems, and as part of the bidding process, the firms were asked to put forth a sample task order with pricing and whatnot. There was a $150 million price gap between their offers, General Dynamics going to the customer with a proposal at $180.1 million. Unisys, using their stealth microsegmentation technology, their proposal was a $30 million task order. So clearly there was no justifying the higher price point of General Dynamics, even though, notably, the TSA had expected the bids to come in even higher than General Dynamics' proposal. So even though General Dynamics was making its best effort to come in at what it thought was a competing price or a competitive price, Unisys, leveraging their commercially developed stealth solution that they're bringing to market in as many areas as they possibly can. It's really what their go-to-market is hinging on, stealth. They're able to undercut on price, and we're seeing Unisys popping up more, partnering with Leidos on the next-gen enterprise network recompete, the IT services component of that. That's currently held by Perspecta. That's going to be a fascinating program to watch as that rolls out, and what we expect there then is Leidos, which made this big scale play a couple of years ago to enjoy economies of scale, lower their wrap rates, be more competitive from a pricing standpoint. Partnering up with Unisys, a firm that we're seeing doing these things and disrupting through commercial technologies, it indicates that's going to be a competitive offering that they're going to deliver on that Navy recompete. So that, I think, pivots perfectly over to some of the stuff that Brian is working on.
Yeah, what it really gets to, going back to the axis flipping, is that the top of the stack was very much an old, what I call labor-based project type of engagement. How many labor hours will it take at what billable rate in order to deliver these things? Now it's flipping. It's more, what is the IP that we can monetize? What's the price that it can bear in order to maintain the profitability that goes in there? What you're going to have to see is the operating margin of traditional services firms, or the gross margin, of traditional services firms start to climb. The way that I look at it is, if you think of services, software margins that are much, much higher. If you say it's a 50-50 split between monetizable IP and these services, then you have to merge those two income statements in order to get to a much higher margin improvement, which goes to how you price it and how you can determine what is the value lever that you can command the premium price on. And that's a lot of the work that Brian is doing. So with that, I'll turn it over to Brian and ask for the slide to be flipped.
Great, thanks guys. And I think that Unisys deal is a good pivot point for what I want to talk about, because essentially what I want to do is take this idea of wallet versus will and some of the kind of publicly announced examples that we've seen, the Unisys deal being a great example of that, translate that into what are the questions we're being asked by vendors in your shoes, and what do we think that means for the questions you should be asking given this wallet versus will transition going in the market. So I think we talked a bit, looking at the left hand of this slide, about the pervasive changes that are driving wallet versus will. Geoff talked about the consumerization of IT, new buying patterns, shifts in procurement, moves to shared and managed services, disrupting buying paths, disrupting traditional deals. The architecture of the Unisys deal is a great example. There's massive implications to price because the way that the technology that's available from the commercial sector that can be brought to the government and applied like for like with the sort of old way of doing business, pervasive changes to procurement, to deal shaping, deal structuring, that eventually flows through to folks in your shoes saying, we need to combat this. We can't lose another deal to Unisys like that. We need to establish a portfolio roadmap. We need to get on par with what Unisys is doing in the commercial sector, bring that to the federal sector, be able to compete for that recompete deal. And ultimately, as Geoff and as Joey said, there's direct impacts to price and commercial strategy because of that. Not only the commercial models that are offered, but the actual price points. We've had many clients come to us looking to understand what the commercial price point is for a service or a product so they can bring that to the government sector. So from our clients who are going down this path, embarking on this path, looking to transform portfolio to respond to that wallet versus will transformation, what are they asking us? They're often coming and saying, we know there's aspects of our services portfolio for the public sector that's missing. What should we be selling? What's available in the commercial sector? What is that Unisys technology? What does it look like? What does it do? And how can we replicate that and bring that to the next bid? We need to benchmark our competitors and better understand what they're doing. That then becomes, how do we price it effectively? How does the government in this new paradigm want to consume? What is the right price point to consume at? What tactics and commercial strategies are needed to get there? And so ultimately, a lot of those conversations become, there's a way to do that through research and through structured pricing research. And we'll go into a little bit just our recommendations on best practices for how to do that, given the sensitivity of the challenges in the public sector with accessing pricing research. But it's clear from the questions we get, it's a need. The portfolio has to evolve to accommodate new buying patterns, new technologies. And a structured, systematic way to do that is to benchmark the competitor landscape, benchmark what's out there, and implement that into a strategy and research process. We can go to the next slide. And so there's a lot of content here, but what this comes from is we actually did a webinar for our pricing practice a few months back, where we outlined what we see as best practices for folks in practitioner roles like you in product development, competitive intelligence, strategy, who are looking to establish pricing support product and offering managers with pricing initiatives to establish price governance, price and commercial strategy governance. We think, again, this becomes increasingly important to take and own these tactics in the federal sector, given the disruption that's on the cusp and that's happening from those deals that we see in the market. So without going through in detail, what we've outlined here is ways to take commercial concepts in pricing research and pricing execution best practices and translate them to the federal sector. So much like we're saying portfolio development, price strategy, price structure needs to change based on the wallet versus will conversation, so does the way that research is integrated into a decision-making process as it relates to pricing. Some of the best practices we've seen, I'll focus in on a few as it relates to the federal sector. One is considering adjacencies, and what we mean by that is looking outside of kind of the tight and small community that is the federal government in terms of when you're looking to reset pricing, reset commercial strategy, reset resourcing strategy. We've had, Joey could tell you too, we've had several conversations with folks, either traditional government contractors, other government contractors who are coming in and saying, we're losing skill sets in emerging areas to commercial firms. We're losing them to AWS or whomever else, and we need to attract and retain that talent. So we need to understand what those companies are doing, what they're offering. We know that's going to have an impact on price as well. So we don't want you to only go out and look at XYZ government contractor. When you do this benchmarking analysis, when you look at pricing, look at resource strategy, look at how you shape the resource pyramid for a deal, we want you to look at how a commercial cloud vendor or a commercial managed service provider might do it. And we want to learn from that and become more like those firms. So not only we can compete from a price and a price model perspective, but we can maintain the folks that are needed to effectively do this kind of work. So there's other recommendations here, but I think that's one of the key ones when you look at, from a pricing research perspective, what's really key to the federal space. We talked about consumerization and commercialization of the government contracting and buying and pricing paradigm. Integrating that thinking into your research and your competitive analysis process in terms of proxy analysis, adjacency analysis is a key one. The other that I'd highlight here is about seeking context. So the requests we get around this topic in terms of pricing often land on, well, we need to price to win this next deal, or we need to have the right price point for this specific situation. I think what we're talking about here is a much more strategic approach to not only changing pricing, but how do you completely change the commercial model associated with contracting in the government space? And that's a larger question. It's a question that some are coming to us with, not all, but it's something to consider in your research design, even when you're having a win-loss conversation or you're talking to someone in the sales organization, to not only stop at the feedback of, well, yeah, we lost on price. Unisys was 6 times cheaper than us, but to dig into that and understand what are the implications of that, what are the drivers, is it something beyond the solution that they're able to bring. So that's another one that we like to focus on. We've advised clients on is to not stop at price, and the price to win, of course, is a key aspect of bid and acquisition in the government space, but to think about this more on a contextual, strategic level in terms of how we in the long term shift pricing. We can go to the last slide. And just wanted to highlight, I gave some of the specific questions that folks are coming to us and asking. What this slide provides is just some examples of the work that we've engaged on and delivered. A lot of the questions have been around exactly what Geoff and Joey spoke to, managed services emerging as a priority in the current administration, a dominant model of contracting. We've gotten a lot of questions about how do we stand up a business around this, and there may be contractors that are FedRAMP certified, participate on cloud vehicles or other vehicles, looking to figure out what services they're missing that could create managed services opportunity as agencies move to commercial cloud. there's a significant opportunity to sell managed service on top of that. So we've done several engagements with companies trying to figure out exactly what does that mean from a pricing and commercial strategy perspective in the federal government. Not only where do we have to be priced, but what's the right pricing strategy, pricing structure, where do we spend our time cultivating this business? Those are many questions we've been answering. Another, I think I mentioned before, is that impact of how do we appropriately staff and structure a team to deliver on a large-scale systems integration or services agreement in this new world? How do we attract the right talent? How do we structure that talent? How do we motivate? What benefits do we provide to that talent to align them around our best positioning on a bid? And how do we attract and retain that talent for the long term? And so it's not only commercial strategy, but delivery and organizational strategy as well.
And that stuff's so important right now because obviously one of the emerging trends and significant trends, especially for the legacy ITO firms to kind of offset some of the commoditization of their legacy services, is to heavily leverage automation and service delivery. And what I've come to see is automation can't be the end goal unto itself. Yes, you can use it to, in the near term, alleviate some of the pressures around your costs, but what it also represents is an opportunity to, at the same time, reinvest back into securing the right kinds of talent that are equipped with the certifications and skill sets for agile development and cloud managed services, and whether that's AWS or Azure certifications or what have you. That needs to be done in concurrence. So that was my main takeaway from that program that you referenced that we worked on was with an aerospace and defense company. Very heavily focused on DoD and national security matters, but we're essentially helping them understand what should our engineering organization look like. Mm-hmm. And as you noted, we're not just looking at how do you compare it against Lockheed Martin or against Leidos or against your direct peers, but how do you compare it against what Amazon's doing, because you're literally losing out your talent to Amazon. And I remember that in our discussions with this vendor, they said, what's really frustrating for us is that we spend all this time in recruiting and onboarding and ramping up and training up these skills, mm-hmm. and then these people leave. So that's a sunk cost that we've lost out on. That's to the detriment of the organization, and that's a setback for the organization. So how do you get past those speed bumps, and how do you avoid them in the future? I think that's kind of what you're looking at there and what you're helping our clients work with.
Yeah, and the other aspect too is I think we talked a bit about new contract types and a move to fixed price, and so that becomes if you can source that more effectively than someone else, you can bid more effectively than someone else. Doesn't just become here's the list of rates, here's our labor rate versus our peer. It's much more about labor rates are a baseline, but if we have those folks on our bench and we can source them in a way where we're low-end optimized on our resource pyramid. We can put together a project teams that's going to be more cost-efficient. We can introduce automation in a way that takes labor out of the equation completely. We sell a solution like Unisys that's more automated, a platform that's different than peers, and there's direct price implications as well. So it's all the way from organizational structure to bid strategy to are we price competitive or not as well.
Right. That's also, just to chime in a little bit, that's a place I spoke during my piece on the rhythm of business versus rhythm of public sector regulation. And one of the places where that's becoming very acute is in the financial services sector. FinTech is a term I'm sure you folks have heard. There's a lot of disruption that's coming in that area, both for tax and audit and advisory firms as well as for the regulatory compliance end. And what the private sector has been able to do is to set up automated KPIs so that the review of all the financial transactions done by humans is sort of exception-based. So if there's 90 points on an application, the machine will do the first pass and then kick out the 2 or 3 items that have to be reviewed. The public sector compliance or regulatory method is to randomly select, say, I'm making this part up, 100 mortgage apps and review the paper or review each of the items on all 100. That's how the public sector does it. But in reality, what you could have is pervasive audits, just full-time, real-time audits. But it requires the federal government to change the regulatory policies. The private sector can already do it. The public sector's got to learn and adapt. And the question becomes whether or not they'll, what it will take for them to get there. Hopefully it won't be a crisis that gets them there. And then on the services side, the other thing to consider, the more you automate out the labor, that is sort of a bifurcation of the labor market. That's a whole different question, sort of the disappearing of the middle class. But those high-end sort of solution architects, those salaries are going to increase dramatically. So now, again, think of the traditional way that you price contracts. If you had a long-term deal, you could figure you'd find ways to automate and make things more efficient in the outlying years, and you'll be able to pick up greater margin because you get better at it. Today, what you have to worry about is what is going to be the labor rate of that, rocket scientist solution architect that can diagnose a security breach. And if that salary today is, $150,000, and 3 years from now it's going to be $300,000, you've got to make sure you've got a rate that can cover the labor expense, even though you got less labor involved. So again, that axis is flipping. All these preconceived notions about how you could have a commercial offer for the public sector are coming under attack the same way they've been under attack in the private sector for the last decade.
The other thing that I think of when you mention that is just how I'm seeing more contracts that maybe in the past used to be a 5-year or a 10-year term, but what I'm seeing more of is like 1-year base with 4 1-year options.
Yep.
You may not have time to make up the margin on the back end on that, depending on when the client chooses to recompete it, and then once they recompete, you've opened yourself up to the disruption, as we've already noted through that Unisys contract example.
The more open tools and open platform layers, so you can slide the IP across. I mean, the main thing is the security layer. Security isn't going to go away as a differentiating or customer distinction, but the rest of it is, as Moore's law has made the hardware, I don't want to say irrelevant, but less and less of a factor. Mm-hmm. It comes down to the software, which is automated IP, and you got to find a way to monetize that in order to maintain whole.
The one thing that I don't like to see is companies trying to fight the tide of what's going on here. We've talked a lot about the OTAs, the other transaction authorities, and how disruptive those are, and maybe it's almost a little bit of a loophole that agencies are trying to take advantage of to...
So you can get the proof of concept.
It's how you get it quicker, and it is supposed to be around prototyping, but then we've seen like Oracle, for example, protesting Rean Cloud's $950 million DoD cloud deal, and it's just the legacy opposing the rising tide that's occurring in the disruption in the market, and that's a short-sighted view. You need to kind of embrace it. I just saw today Perspecta, Accenture, and a couple other partners won an OTA-based deal with DISA for a background investigation platform prototype. So you have some firms they're aligning to it, they're embracing it. Consortium are becoming very important with the OTA trend. Companies are trying to find, the ones that are attuned to the way that the market's changing, are finding ways to position themselves to capitalize for the opportunities that are emerging. We have a couple of questions, so let's.
No, we're running.
Oh, okay. Do we have any questions? Because I think we are pretty good. Okay. Well, we don't have any official questions from you all, but please feel free to reach out to any of us. If we said anything that was interesting. Hopefully it was. You know how to reach us. Happy to talk anytime, and enjoy the rest of your day.
All right, everyone. If you have a few moments, please fill out the survey on your screen and let us know what topics you'd like to see us cover in the future. A replay version of the webcast will be available after the event, which you will receive via email, as well as a link to view and register for other TBR webinars. Make sure to join us on Wednesday, August 8th for Revenue Growth Drivers and Opportunities in the IT Services Market. Thanks for joining, and have a great day.